Today, I've got a guest with me, Darren Brisebois from Cerro Verde Advisory Group. And Darren works with business owners, helping them prepare their business for exit. And so today, we're going to talk about the 5 things that business owners should be considering when looking to exit their business. So, Darren, what's that list of 5 things?
Awesome. Well, thanks, Jason, and thanks for having me on. I like to pull it back kind of to the highest of levels, and there's a bunch of subcategories, but I would break out those 5 critical areas into corporate structure, capital structure, organizational structure, due diligence items, and historic information, and selling the future and the benefit of buying your business.
Okay. So when we talk about corporate structuring, obviously that's really important. That's one of the first things that we talk about when we bring on a new client to our office, making sure that they've got the proper corporate structure so that they can utilize the capital gains exemption when they sell their business, making sure that they've got the structure for flow of capital between the different companies, etc. So when you're working with a business family on that, what do you see as important? What are some red flags that you see, or what's some advice that you'd give people?
So for sure, utilizing the lifetime capital gains, ensuring ownership is appropriate. In some instances, there's redundant assets in a operating company that might have to get rolled over to a holding company. So
Mhm.
for instance, there could be equipment that isn't being used in the business. In some instances I've seen, vacation homes and those sorts of things. So yeah, that would be kind of the high level on corporate structuring for tax and for liability.
Yeah, and so what we see there is just making sure that you've got the proper structure, as I said, to use the exemption. So oftentimes, what we find is people don't have that structure, and then it ends up costing them quite a bit of money in tax. And redundant assets, we often see where families will have insurance policies inside their operating company or investment portfolios or a large amount of cash. And so I think that's what you mean by redundant assets, making sure that you get those assets out of the company because those can throw you offside for the exemption. And at the end of the day, you're not looking to sell those assets with the sale of the operating company anyway. What about capital structure now? So what's some things that you can talk about there with respect to making sure the owners are organized with respect to that?
So on the capital structure side of things, mostly focusing on the debt side of things as opposed to the equity. So oftentimes there would be intercompany loans that would have to get taken care of prior to selling the business. So there may be an embedded tax liability in there. Also, the debt that the business holds either for operating or for capital assets. Are those debts going to be transferred to the new owner? Can they be transferred? Does the current owner have personal guarantees and the likes that would be attached to those? So, capital structure would be really focusing on making sure that all the balance sheet items are appropriate for a sale.
Okay. No, that's good. We often see it, yeah, where there's lots of different intercorporate loans and it can get really, really messy. So making sure that you address that well in advance of a sale, I think is important. So when we look at the organizational structure of a business, so the internal organizational
Yeah.
structure, so management teams, employees, etc. Obviously, that's a huge part of the business. Making sure that you have that structured up right is going to be extremely important for a sale, because at the end of the day, that's what the buyer is buying. So, what can you offer there with respect to some ideas?
Yeah, so a lot of time is spent on understanding, the organizational structure, what bums are in what seats, who's currently doing what in the organization, and how is that going to transfer over to the new owner.
Mhm.
So taking a step back in understanding the process, you always need to understand who's ultimately going to be buying the business. And
Mhm.
I would break that into 2 different groups. There would be a strategic purchaser or a financial purchaser. A strategic purchaser would be typically a competitor or somebody that's already operating that wants to get into your business. And a financial purchaser could really be divided into 2 different aspects, like a private equity company that would be looking at purchasing the business and having somebody run it, and they would manage it from a high level
Mhm.
perspective. And there's also financial buyers that would purchase the business for something for them to run. So, understanding who your buyer is always important because that's going to affect what the organizational structure should be. If you're trying to sell to private equity, well, you better have a good management team in there. Um, So yeah, those would be some of the things that I would be looking at, making sure that you've got an organizational structure laid out to be able to show the potential buyer. Ideally, if there was employee reviews, understanding of, and breakdown of compensation of all the individuals, length of tenure, age. Those are the types of questions that a potential purchaser should be asking.
Okay. No, that's interesting. Also, I'd like to add to that that the owner often is very involved in the business, and that can be a problem when you go to sell it, because if the owner is super vital to the operations, the business isn't going to be as valuable as what it could be if they had a great management team in place. So one of
That
the things that we talk to families about often is making sure that the owner is not super involved and that they do have a management team, because that way when someone comes in and buys the business, it's more turnkey, and you'll definitely receive a higher price for it if that's the case.
sorry, Jason. It's typically the biggest issue is not being able to step back from the business. So there needs to be a
Yeah.
period of time when the business owner doesn't come into the office and ask all the questions. They become accustomed to managing the business through reporting and slowly taking that time to move away from the business. Because if the business is the business owner, technically that's considered goodwill. Personal goodwill does not transfer in most instances. And those are the types of situations where founders or operators of businesses will be forced to, shut down the business or liquidate for the value of the assets. From a valuation perspective, too, a smaller company where a new owner is going to have to come in and manage the business and then build up that infrastructure is going to be trading at a lower multiple to earnings or revenue or however that business is valued. So if you're
Mhm.
able to put those bums in those seats, it is going to assist with the transfer, but it's also going to optimize value for you in the transition.
Yeah, that's super important. I actually think it's really difficult for a lot of business owners to start to exit from the operations of their business
Yeah.
because it's their baby. They're used to it, right? It really does give them a sense of significance. And so they feel that they're not being as valued as much or things like that. And so it can be very challenging for them to step away. But the reality of it is if they're not able to step away, they're not going to have a business that's going to be greatly saleable. And so it's important that they keep that in mind. And, that takes us to the due diligence side. So, when you go and you sell a business, the buyer is going to send in a team of lawyers and accountants, and they're going to look at every aspect of your business from top to bottom. And the due diligence process is an onerous process. It takes a lot of time, it takes a lot of energy, and it's something that you want to be prepared for. And so, Darren, what insights can you offer with respect to that?
Yeah, so the due diligence, and historic information, that's really making sure that all your ducks are in a row. Everything is put together into a package or a data room, and you've thought through all of the questions or items that the purchaser's operating team, financial, or legal advisors could want to uncover or understand about the business. So from a
Mhm.
financial perspective, making sure that all of your year ends are filed internally, making sure that you have tight monthly cutoffs and a strong history of, having those processes laid out. Employee reviews and insurance contracts would also be
Yeah.
something that you'd want to have in there too as well. But the due diligence items to the fifth point, which is selling the future and the benefit of the business. So you always have to think of, okay, who's buying the business and what's in it for them. So if you
Right.
say that you operate in three different business lines and one business line is providing you with a lot of growth and the other two are stable, well, that better be broken out into your historic financials so that the purchaser can see those trends and intersect those historic information on those different business units with the forecasting information too as well. So
Mhm.
you get into a situation where you say, well, growing a lot in Edmonton. Historically, the business is in Calgary. Well, if you can't show that breakout of how that growth in Edmonton has been unfolding over the past number of months or number of years, you're going to be kind of be left scratching your head or chasing your tail for due diligence items. So making sure that those um, are all really in line and link up with the story and what you're selling to the potential purchaser.
So that's a great transition into looking at, selling the business and selling the future prospects of the business. Obviously, when you're selling a business, the new buyer is going to look at the past. They're going to look at the financials. They're going to look at where you've come, and they're going to want to understand what's in it for them. Like, why would they buy this business? And ideally, they want to buy a growing business. And so, I think it's important that you have a story as to what the potential of this business could possibly be, right? And so, we see such things as forecasting, right? So your sales have hit a certain point as of today, for example, but you're forecasting much better sales. And what are you doing to actually accomplish those forecasts? But what are some other things that you might consider there, Darren, that would be important for owners to look at and deal with?
Yeah. So, at a high level, understanding who your buyer is and exactly what you said, what's in it for them, areas of growth relative to the historic trend line. Does growth in Edmonton in your forecast make sense with how it has been trending historically?
Hmm.
One of the other things about forecasting is that you're going to be held accountable to them in the due diligence period.
Hmm.
So right out of the gate, the buyer is going to ask for, what are your forecasts? A transaction could take anywhere between 6, 8, 10 months in some instances. So through that period, you're going to be held accountable to those forecasts. So predictability and understanding how to do that is going to be an important part of the puzzle.
Well, and I think you'll even be held accountable to those forecasts down the road because you're likely not going to get paid cash up front for those forecasts. That's where you'll get paid out an earnout, right?
Yeah.
So if you hit these forecasts that you're expecting or that you're selling the story on, then you'll get
Yeah.
paid for them only after you hit that. And
Yeah.
so that's an important thing, and it just holds everyone accountable, making sure that it's a realistic story and that you actually do have a plan to accomplish that, right?
Yeah. And I would say the last thing is buyers always want to look from a valuation perspective. Buyers always want to look at the history, the last few years. That
Yeah.
is what actually happened. It is the job of the business owner and the advisor to push the future and to show that growth so that you can argue for a higher multiple and a higher valuation when you sell the business. So it's definitely imperable.
Good. Well, this is good. I think the story here is, and the thing to take away from this is, it's really important to make sure that you plan ahead for the sale of your business. If you're planning on selling your business within 5 years, the time to start getting prepared for that is today. You don't want to leave it until the last minute, because if you do, it's going to end up costing you a bunch of energy, time, money, frustration, and all that. And the more prepared you are, the better valuation that you're going to get. So I hope that you all found some value in this. So if you ever want to reach out to Darren and learn a little bit more about what he does, you can check out his website. That's going to be CERROVERDE.ca. And if you want to learn more about us and what we do here at 360, you can check us out at 360wealth.ca. Our wheelhouse is working with business owners who are within 5 to 10 years of selling their business, or they have recently sold their business. So thanks and take care. Thanks, Darren, for joining us.
Thank you.